Continuing to move forward, talking about equity securities and how we account for them and what the reasons are for the differences in how we do account for them. We've talked about insignificant ownership, that less than 20%. However, if there is ownership in another entity between 20 and 50%, the investment, direct or indirect, then there is a presumption that in the event of absence of evidence to the contrary, that the investor has the ability to exercise significant influence over the investee. When there is significant influence, the investor needs to account for that investment using what we call the equity method. And we'll look at that a little bit more in depth. But let's think about this ownership threshold of 20 to 50%. If 20 to 50% of the outstanding stock is owned by one particular entity, then they have some pretty substantial voting rights. With that, they may have presence on the board of directors, they may have a part in policy-making decisions, they may have some material intercompany transactions, there may be some technological dependency between the two entities. There are a lot of things that can happen. When that happens, the instance is that absolutely there is such a close relationship between them that we need to illustrate that appropriately in the financial statements. So we're going to do a comparison between what's called the equity method and the fair value method. And we're going to look at recording the investment at cost and the subsequent adjustments for each period regarding an investor's proportionate share of the earnings and any dividends received by the investor. If by chance the investor share, their prorational share in losses exceeds the carrying amount of the investment, then what the investor does is that they discontinue applying the equity method and they don't recognize additional losses. They will kick back in as earnings, as gains, as an income are generated. Underneath the equity method, the investment account is increased or decreased by the investor's share of their earnings, and decreased by dividends actually received. So let's look at how that works, doing a side-by-side comparison between using fair value and the equity method. Here we have the basic fair value. We've talked about that when we were talking about holdings less than 20%, how we treat things. We recognize them as costs. We use the fair value adjustment account for an unrealized holding gain or loss in income, as a difference occurs between the fair value or market price of the shares and what our cost on our balance sheet is for them. We recognize dividends as income in the period in which they're received. Pretty straightforward. But using the equity method, it is different. Let's start with the actual purchase. It is the same. It is what we paid for it. However, in year 2017, Mini Company reported net income of $200,000. Maxi Company owns 20% of Mini Company. Therefore, 20% or $40,000 of the net income is referenced on Maxi Company's books. It's an increase to the equity investment, and it's recognized as investment income. This doesn't happen when we don't have significant influence underneath the organization. So it doesn't happen underneath that 20% threshold. Then on December 31st, we also have the comparison of market to the amount that was paid for the shares. Underneath the equity method, this does not apply. The market adjustments up and down are not a consideration. So think about it similar along the lines of we don't adjust our own equities as a result to changes in the market. We also don't underneath the equity method. Then on January 28th, the company announced and paid a cash dividend of $100,000. Dividends are a returning of earnings to the stockholders. We increase the value of our equity investments by our share of the earnings for the year 2017 by $40,000. On January 28th, 2018, we received 20 of that. So we will reduce our equity investments by $20,000. And then for the year end 2018, there was a net loss of $50,000 because we do own 20,000 or 20%. That's $10,000 of loss. So we will recognize an investment loss of $10,000 and reduce our investment by $10,000. And then on December 31st, 2018, also underneath the fair value side, we had our fair value adjustment. Remember, underneath the equity method, we don't mess with fair value adjustments. There's no entries for those. So what we do, in a nutshell, underneath the equity method is that we initially recognize what we purchased our investment for. And then as the years go by, we take whatever that net income or net loss is pro-rationally and either increase or decrease our investment account by that, representative of investment income or investment loss, depending on the situation. And as we receive those earnings in the form of dividends, then we reduce the value of our investment account by that amount because we have received those amounts. That has been completely recognized, completely fulfilled. There's no obligation at all. There's not even a presumption of any obligation for those amounts after that point. Now, there is an option for some securities that would otherwise require the equity method of accounting being reported at fair value. If this happens, then you follow the general fair value rules, and we'll actually have an entire thing on fair value. But using that, then you're going to see those same adjustments as you see here. Fair value adjustment to the unrealized holding gain or loss. When that happens, we don't report the pro rata share of income. And any dividends are then credited to the dividend revenue account and wouldn't reduce the equity investment on the books. One of the reasons that companies may elect to use the fair value option versus the equity is that it can address some of the confusion as far as what needs to be consolidated in the one-line consolidation related to the equity method of accounting on the balance sheet and how to report that to the investors. It is deemed to be less accurate, less transparent. It does, and when you're using fair value for these types of investments, is clear a representation of what the company's liquidity or solvency position might be. Because if you own more than 20% in the organization and they are an integral part of your industry, your selling of it may actually create a problem for you if that is a key vendor. If you suddenly sell off that 20% because you feel that vendor is not performing correctly, you may create a selling frenzy, which could adversely affect that vendor. There are a lot of different things that can go into the consideration of how liquid an investment is this. Is this something that, if need be, we could liquidate if we needed to very quickly?